Hey, everybody, welcome back to Chipstock Investor. There has been a lot of discussion surrounding hyperscalers and their CapEx spending. And we're going to talk about three different points today that we feel like need to be cleared up to truly understand the Nvidia cycle, as well as the cycle that hyperscalers are going through. When I say hyperscalers, I mean, let's say Google and Meta, for example. We'll be focusing on those two today.
Here's what we're going to discuss because I feel like we helped do our small part to create this monster. And now there's a lot of very misleading research out there. Maybe it's not intentionally misleading, but there's just a lot of people talking about semiconductors and data center CapEx. And they knew nothing about that topic whatsoever until the last year. So we're going to clear some things up about that. We have a metric to share with you. We actually talked a bit about this metric a couple of months ago. Not very many people saw the video about the AI bubble, so-called AI bubble. We're going to talk about it again, though. And then finally, do we have the perfect NVIDIA stock hedge hiding in plain sight? If you know the proper metric, you're going to know the answer to this question before we even get to it, but we'll help you walk you through it.
First things first, let's talk about just how much cash is on the balance sheet for the Magnificent Seven plus Netflix. There's nearly $500 billion in cash and short-term investments on balance ready to be deployed, and over 385 billion in free cash flow generated over the last 12 months. That is an incredible figure.
That's what's fueling NVIDIA right now. All of these companies, hyperscalers, companies that utilize or own and operate data centers and rent those out to their customers, are fueling this CapEx cycle. And in case you're not sure what we're talking about, CapEx is capital expenditure. That is money that is spent on equipment, in this case, property and equipment, that being data centers and the accelerated computing systems, or if you like, AI systems, purchased from NVIDIA and crammed into those data centers. These companies have cash, and that is a good thing if you're an investor, because you don't want the cash just sitting for forever idle on the balance sheet. You want it to be deployed in something productive that is going to earn more profit down the road. So let's talk about that profit.
We're going to introduce you to a couple of metrics that we're using to look at what hyperscalers are spending on and how that affects NVIDIA. On this slide that we made using FinChat, which of course you can check out in our link below. You can get 15% off a membership to FinChat. Awesome tool that we're using in all of our videos now, you may have noticed. But we're going to first start with Google or Alphabet. You can see the CapEx to revenue is in orange and CapEx to OCF or operating cash flow in blue. Everyone is focused on CapEx to revenue, but a metric that you really should be looking at is that line in blue, CapEx to OCF. Nick, maybe you can walk us through why that is.
Yeah, super important metric here. This is simply a ratio of the CapEx or spending on equipment, in this case, things like NVIDIA's accelerated computing systems, to Google's operating cash flow, operating profit. And all of the talk has been, there's all this spending happening on AI. First things first, it's not actually spending just on AI. That is one very small use case for these accelerated computing systems. We're going to get into that in a moment. But if you look at this chart, it's actually not all that elevated. It's actually well within historic norms. Now, on an operating cash flow basis, maybe it's a little bit above the average, the historical average, but again, still within that historical norm going back roughly a decade and a half. And there's a lot of concern about this getting out of hand. But remember, companies like Google are still growing. Their profits are growing faster than their revenue. And so they can actually afford to ramp up their spending, their capital expenses on this equipment. And that ratio will still stay within the historical norm because the profit is growing. So the CapEx can continue to rise as long as the operating cash flow continues to rise. What we have charted out here is GAAP earnings per share alongside free cash flow. Free cash flow has taken a dip as of late because of the elevated CapEx, but nevertheless, you can see overall the profitability on multiple bases continuing to rise for Google. Kasey, something very similar happening over at Meta right now, right?
Okay, we have the same metrics for Meta in this chart, very similar happening at Meta, well within historical norms on that CapEx to operating cash flow. This slide shows Meta's total revenues over the last decade and a half, as well as earnings per share and free cash flow, just like we showed you with Google. And Meta can afford to continue spending so much in capital expenditures as long as their profits continue to rise, and the ratio of CapEx to OCF will remain within historical norms.
And this is so important because there's all this fixation right now on hyperscaler CapEx being out of control. Yes, Nvidia revenue has skyrocketed, but that does not mean capital expenditures from their biggest customers, Meta, Google, Microsoft, so on and so forth, Amazon, AWS, the Magnificent Seven. That doesn't mean CapEx is out of control. They can afford it. We said this almost 2 years ago now. Nvidia leveled the playing field. Everybody needs to spend this money so that they keep pace with each other technologically because they do compete. And all that money is just simply accumulating to Nvidia now because they make the best accelerated computing systems and they have all the software tools to make them the most useful and the most usable. So these charts are super important. The one thing you need to take away from this video, probably that. Where are we at in the cycle? We're not at the end of the cycle, at least from a historical average perspective. We're maybe just barely on above average. So we think this CapEx cycle still has legs.
This episode is sponsored by public.com. Heads up, everybody, time may be running out to lock in a 6.9% yield at public.com.
Right now, bond yields are at their highest levels since 2009, and you can take advantage with a bond account. But here's the thing. The Fed has signaled potential rate cuts in September.
And there probably will be more to come this year and into 2025. The good news is with a bond account, you can potentially lock in that 6.9% yield until 2028.
And then when the Fed does lower interest rates, your yield actually remains the same. It's locked in. But you must act fast to take advantage of some of those highest bond yields in years.
Discover how you can lock in a 6.9% yield until 2028. The new bond account only at public.com. Check it out now at public.com/CSI. Let's look at a few quotes from both CFO of Alphabet, Ruth Porat, and CFO of Meta, Susan Li, regarding what this CapEx is actually getting spent on.
And why do we need to look at this? Again, it's important. There's a lot of talk out there, incorrect conversation, in fact, happening about all of this CapEx being spent on AI, generative AI, and there's no use case for it yet. That is false. If you hear someone talk about that, they simply do not understand this industry. Kasey, walk us through this quote from Ruth Porat on the last earnings call. This is an important one.
In this first slide that we quote CFO Ruth Porat, you can see that she's talking about the margin expansion in Q2 and the ongoing efforts to durably re-engineer the cost base as well as revenue strength. So Google is actually spending money on their already existing infrastructure. They're putting those Nvidia GPUs to work in the ad business, which is Google's primary growth driver.
Yeah, not generative AI. And if you like profit margin expansion, you can thank Nvidia for that. That is in large part what Porat is saying here. Thanks to those accelerated computing systems, Google ads keep getting better. The ad targeting keeps getting better. And therefore, Google keeps growing its revenue and profit margins expand alongside that. All great stuff. And so when she continues to say in these next following slides that they're going to be spending more on CapEx in the subsequent quarters, you can see that here we have highlighted at the bottom of this slide. CapEx in the second quarter is going to be $13 billion, again, spent on technical infrastructure. That's their existing data centers. And in this final part of the quote, Porat says CapEx in Q3 and Q4 will be at or above $12 billion, causing a bit of angst on Wall Street. But again, this is all good stuff. Google can afford it, and the CapEx should go up as long as revenue keeps going up and profit margins continue to expand on the existing ad business. That's primarily where this Nvidia equipment is going. It's not generative AI. This is fantastic return on investment work from Google.
How about for Meta? The reason we're using Meta as a comparable to Google is because Meta also primarily makes their money off of ads. So looking at what CFO Susan Lee had to say on the Q2 earnings call, the first thing she brought out was just exactly how much they're going to be spending. And she said they've updated it to 37 billion to 40 billion, up from 35 billion to 40 billion in 2024. And they continue to reiterate that in 2025, they expect significant CapEx growth. As with Google, Meta is also focused on getting return on investment of this new infrastructure.
And again, just to drive the point home here, yes, some of this new accelerated computing equipment purchased from Nvidia is indeed getting spent on things like generative AI. And Lee says that there's no expected bump in revenue as a result of this Gen AI. However, remember, most of this infrastructure purchased from Nvidia going into the existing data centers is primarily being used to enhance Meta's recommendation systems, to help make the ad delivery business more efficient, to keep users engaged on the platform. All of that helps with growing the revenue for Meta and increasing the profitability. Now, I think maybe just a brief mention here, the Blackwell system from NVIDIA is coming out starting in Q4 of this year, which starts here in just a couple of weeks. More pictures of that really cool looking chip. And then the whole fleet of data center servers connected to each other with tens of thousands of these GPUs now. There's going to be a constant chorus of voices in the coming quarters trying to tell you that the hyperscalers are spending way too much money on these chips for generative AI because they earn no money from generative AI yet. Please keep this in mind. They're not spending this money primarily for generative AI. Some of it they are, yes, but primarily they are just simply improving their own systems. And so the metric that you really want to focus on is CapEx to operating cash flow. As long as it stays within historical norms, like it has been this past year, they're probably going to be getting good return on their investment by buying these things and plugging them into their data centers.
So let's focus finally on this third point, the perfect NVIDIA stock hedge. Let's talk about that. These companies may be the perfect NVIDIA stock hedge hiding in plain sight, the hyperscalers.
And why is that? I think this makes perfect sense if you think about it for a moment. Everybody's freaking out about what happens to NVIDIA when the hyperscalers slow down their spending on accelerated computing systems. However, if you're tracking CapEx to operating cash flow, what happens if the capital expenditures drop?
Profitability.
Profit goes up.
Profit goes up.
And while we all know what Wall Street thinks about profit going up, they like it.
They like it. So do we.
So do we. So if you own NVIDIA stock, you probably might also want to think about owning some of the hyperscaler stocks as well, if you don't already.
Let's focus a little bit about the possible timeline that we're in for all of these things, the AI infrastructure boom. In this chart, you can see that AI infrastructure, as we put it, is a new market and currently in max growth mode. But where does that leave us going forward?
Well, NVIDIA obviously has a lot riding on data center infrastructure, but there's a lot of other data centers outside of the hyperscalers that also are going to need accelerated compute updates. That falls under the cloud and enterprise market, which is just barely at the beginning of a new growth cycle here in Q3, Q4. We won't address consumer and automotive markets in this video, but let's jump to this slide that we have not talked about for a while. We've done a couple of updates based on new information that we've been getting from NVIDIA and from the hyperscalers and other consumers of chips throughout this year. 2024 is the start of a new bull market for the semiconductor industry that will expand to more end markets in 2025 and 2026. But it's sometime in 2026, at least a year, if not more from now, where we have to start looking a little bit more closely at the end of this growth cycle. There's going to be another down cycle at some point. We're not there yet. Maybe this time next year, maybe that's the time where we'll start being a little bit more critical and thinking about scaling back on some of our shorter term bullish notes on the semiconductor industry. But as far as where we stand right now, it looks like things are looking pretty good, at least from our standpoint.
Why do we have an illustration of a boxing ring?
Yeah, Kasey, you actually mentioned this in some recent conversations we were having in our research. When investing in a cyclical industry like semiconductors, albeit a growth industry, but cyclical, it's really important to zoom out at the bigger picture because it can be very easy to hyper focus on these shorter term up and down cycles, trying to get the timing right every couple of years. Do I need to sell stuff? when's the right time to get back in. If you want to be a passive investor in semiconductors, you can, and you will clobber the market. At least over the last 20 years, you would have obliterated the market, even the NASDAQ, investing in top semiconductor stocks despite these cycles. So when we do get that down cycle, perhaps it starts in 2026. What's really actually happening is companies like the hyperscalers are probably just going back to their corner at the end of a round, catching a breath, maybe getting a quick drink of water, and then headed back into the ring for the next round.
Getting their nose fixed. For us, especially, the ultra long-term cycle remains intact, and our investment thesis in the semiconductor industry remains intact. So we're not making any changes to our Nvidia position. We are also hedging our bets with hyperscalers like Google and Meta.
Have been fantastic investments for many years. They're great to own anyways, but yeah, if you're worried about what happens to Nvidia, that's just one more reason to maybe take another look at owning those.
Thanks for watching this episode of Chipstock Investor. Make sure you check out our sponsor and the Semiconductor Insider membership for just $5 a month. That membership gets you access to Discord and all kinds of cool benefits. See you again soon at Chipstock Investor.